It's going to get worse. Inflation is here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following.
Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation?
The answer is that you have to look at the yield maturity on the 10-year Treasury note. That's our benchmark security.
A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions.
The 10-year note is the right benchmark for those large long-term investments. Well, that's an alternative place to put money. You can buy gold. You can buy a 10-year Treasury note. So what has been since last summer is as the yield to maturity on the 10-year note goes up. That strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield of maturity in the 10-year note goes down,
then that weakens the dollar and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold.
So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of dollar, which is reciprocal to the interest rate on the 10-year Treasury notes.
But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it.
And you're like, well, Jim, why in 1971? Why not before that? And of course, 1971. It was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband like drugs or, machine guns or something. But foreign trading partners could redeem dollars for gold. Up until 1971, then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. Go back to the 1920s or earlier. Through much of the 19th century for the United States and sterling, I think it was 4.75. It could be off a little bit on that, but for pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time, Bombay today, Mumbai, you took a person. British sovereigns.
British sovereign is about 8 grams, a little bit less. It's not an ounce, it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth, almost $2,000?
You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time. And it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, gold was the money. And people thought about it by weight.
They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever.
So, and that was true throughout history. And so it's really only since 1971 when you decouple completely in terms of an exchange rate that you have to think about, what's the dollar price of gold? Because it's not fixed. But what happened to the memory?
What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914.
1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need it.
They would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war.
The war started in 1914, so for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank and they gave you paper money, and the people did it out of a patriotic. It's existential. War is not a normal market. You know, if you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars, and they said, "Don't worry, your money is backed by the gold. But keep using that paper money, but it's redeemable for gold." By the way, they are 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you have seen one, and I have as well. They are heavy. They weigh about 35 pounds. You don't walk about with them. So all of a sudden the gold was still, and the paper money was backed by gold in theory. But the gold had disappeared into the banks. That's step one. Step two. This happened in the 1930s.
Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank.
And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. You and I revalued it. The answer is at today's market that $11 billion is actually worth $470 billion. So the Fed has a hidden asset of $450 billion. That's not on the balance sheet represented by a gold certificate, but it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? Talking about the United States Treasury owns the gold. The Fed has a paper certificate. The gold is on 2 Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse to commercial banks, to central banks, to finance ministers held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it. And everyone pretends it's not money, but of course it's money. But meanwhile, what's happened to the civilian population, the citizens? Thank you for watching our documentary. We hope you enjoyed learning about the Fed's secret. If you found this video interesting, please consider subscribing to our channel and turning on notifications so you don't miss any of our future updates.